talk about the secret to avoiding blame. Are you ready? Blame global warming. That's what the politicians do. It's what the media does. Try it for yourself. See if it works. Okay, now let's ask the question. Would you rather do the calculations first, or do you want to talk about the last few slides of chapter 16?
I'm not doing the exam.
You're not doing the exam?
The exam first.
Oh, you are for doing the exam?
Yeah.
Okay, raise your hand if you want to see the exam stuff first. Okay, and we got an undecided. I think we'll do that. Okay, now it turns out I looked, and I think maybe 3 of you have actually looked at this damn thing, which is a little. Those 3, if you've looked at this and you had questions, what I want you to do is shout out which numbers gave you trouble. And I already know that numbers 8 and 12 gave you trouble because they were messed up.
Okay.
This is the first time I've used this one, so they were messed up. So, other questions that you want to hear?
Mine were just 8 and 12.
Just 8 and 12?
Yeah.
Anybody else?
I have a couple of them on my computer. Is it okay if I pull it up real quick?
Yeah.
I apologize.
Anybody else? Mr. Bardwaj, is that what you're doing too? He's pulling it up on his phone. So I'll go ahead and pull number 8 up here because we know we're going to do it. Okay, a firm uses $40 million of debt, $50 million of common equity, and $10 million of preferred stock to equity, preferred stock to finance its assets. Its before-tax cost of debt is 6%. The cost of preferred stock is 9%, and the cost of common equity is 17%. Calculated at the weighted average cost of capital for the firm, assuming a tax rate of 30%. This is a little different than what you're used to seeing with the weighted average cost of capital. Why?
There's preferred stock.
Yeah, there's preferred in there, but it's the same basic idea. And so what we're going to do is we're going to figure out the value of preferred, the value of the debt, and then the value, we'll call it C for common. Now, if they tell you required return on equity, that means common, unless they say preferred. Okay, so we've got the, and then we're going to figure out the value, which is going to be the sum of those things. And then for each one of those, we're going to figure out a weight. And this weight on preferred is just going to be P over V. Oh, by the way, this is just P plus D plus C. This one's going to be D over V. Any idea what this last one's going to be?
C over V.
Yeah, C over V. Now, all these have to add to 1, so that's a way to check your work. They tell us that the firm uses $40 million of debt. These are all in millions, so I'm just going to write the number. I'm not going to write out all the zeros. 10 million of preferred stock and 50 million of common stock. So if I add 10, 40, and 50 together, what do I get? 100. Can you tell I'm trying to make the math easy here? Okay, so P over V is then 10 over 100, and what is that equal to?
10%.
Yeah, 0.10. D over V, we've got 40 in debt, divide by 100, 0.40. And then here, we've got 50 million in common, 100 million total value, 0.50. Now, just for fun, add those weights together, not for fun, to make sure we're not screwing up. If you add those weights together, they've got to equal 1. If they don't, we've done something wrong. Now, the next question is, what do I do from there? Well, remember, our typical RWAC formula looks like this. It's the weight on equity times the required return on equity, plus, I'm going to leave some space here, plus the weight on debt times the required return on debt times what?
1 minus the
Yeah.
tax rate.
1 minus the tax rate. Now, keep in mind, this thing said the before tax cost of debt. If they said after tax cost of debt, what would we do differently?
You would
we just moved this right here, and we would put the after-tax cost of debt in here, because this is the after-tax cost of debt. Okay, now that's your typical formula. We've got one more term here, and that's the preferred term. So we're going to take the weight on the preferred multiplied by the required return on the preferred. And so the weight on the equity, we said, and it's common in this case, is 0.50. And what's the required return on our stock?
17%.
Yep. 17% plus the weight on preferred, which is 0.10 times what?
9%.
9%. Plus the weight on debt, which is 0.40 times, what's the before tax cost of debt?
0.06.
0.06. 0.06, or, let's see, required return, oh, no, sorry. We're looking at percentages here, right?
Yeah, 6%.
Yeah. So the trick is, if I keep these things in percentages,
Yeah,
as long as I treat them all the same. By the way, remember, I don't know if I told you, Doug Whitty was my professor at Mizzou, and I kept getting one of these wrong. And I said, what's going on here? He says, well, you're using percent here and here, but you're using a decimal here, dumbass. And I said, oh, you're right, I am a dumbass. Okay, so there we go. Multiplied by, what's the last term? 1 minus t.
Minus 0.7.
Yeah, so it'd be 0.7 because it's 1 minus 0.3. Whew. Okay, so now we can go through here. I think this is 8.5%. I think that's 0.9%. And we've got 0.4 times 6% is 2.4% times 0.7. I think this is 1.68%. Tell me if that's what you get. Does that sound right? Yeah, you guys are the ones with the calculators here. I'm getting 1.848.
You had it right up there.
I have it right on the board?
Yep.
It'll teach me not to trust my brain. Okay, so what do I do now with all these numbers? Yeah, and when I add them all up, 8.5, so that brings us up to 9.4, 10.4, how about 11.08%?
Yeah, that's what I got. I just didn't, there just wasn't an answer. that I
Yeah,
said.
and my apologies on that one. So I went through and this is the first time I've tried through this. So I went through all these and actually worked through it twice. I don't know how the hell I missed that. But if you had followed my directions of choosing the best or closest answer,
Yeah,
you would have still gotten it right.
right.
Okay, so that's number 8. Now we also know that we want to see number 12. I'm going to erase all this. Someone got that written down? We really need to get some erasers. When I was teaching in China, the students would run up and compete over who could get to wipe the board. It was interesting. I see that none of you are going to replicate that experience. Okay, so here we go. Globe Service plans on closing its doors after one more year. During its last year of business, the firm expects to generate a cash flow of $67,000 if the economy booms and $44,000 if it does not. The probability of a boom is 90%. The firm has a debt of $53,400 that's due in 1 year. That's the face value of the debt. The debt has a market value of $45,800. You can think of that as the price of the debt today. Ignore taxes. The current promised return on the debt is blank percent, and the expected return on debt is blank percent. Okay, so the promised return is really easy. I take the amount that's going to be at the end, which they're promising $53,400, and then I'm going to subtract something. What am I going to subtract? I'm trying to figure a return here.
Just the return price, the 45,800.
Yep, 45,800. By the way, I'll go ahead and write the formula out for you, because its return is equal to t plus 1 minus p sub t divided by p sub t. Does that look familiar? That's a typical kind of finance return. Now, what does that mean we need to put on the bottom here?
45,800.
45,800. And so, pull my calculator up here.
16.59%.
Let's see. I lost my calculator somewhere along the way. Okay, so 16.59%. Now, test strategy. What does that immediately tell you?
It's either A or D.
It's either A or D, right? Okay, so now you've narrowed it down to getting a 50-50 shot. Now, the second question is, what is the expected return on the debt? And this is where it gets really hairy. What's the probability of a boom?
90%.
0.90, and then a bust? What does the bust have to be?
10.
Yeah, because they're only talking two states of nature here that got to add up to 100%. Okay, so the value of the firm in a boom is how much? 67,000. And what is it in a bust? 44,000. Now we're going to figure out what is the value of the debt in each of these situations. If the firm brings in 67,000, how much do the debt holders get?
The full 53,400.
Yep. 53,400. But if the firm only brings in 44,000, what do they get?
40,000.
44,000. Okay, so now we can figure out what is that expected value of the debt given this situation. So we're going to take the 0.90 multiplied by 53,400 plus 0.10 times 44,000, and this is going to give me 4,400. I can't do that one in my head. .9 times 53,400. I'm getting 48,060. Is that what you get? And so when I add my 4,400 to that, I get 52,460. Okay, so here, that's our expected value. How are we going to find the return? Well, we're going to take that 52,460, subtract the current price, which was how much?
45,800.
Yep. 45,800, and divide by 45,800. I'm getting 14.54%. Is that what you guys are getting? Okay. So that's the correct answer. However, on the practice, if you want to get it right, just to make the bell ring, you'll click that last one. I don't know where the hell the 4.93% came from. I do know how I got the other one wrong. I changed like 5 numbers in it, and the tax rate was one of them. But when I came up with a number, I went back and used the old tax rate instead of the new tax rate. So if you rework number 8 with a 35% tax rate, it would be correct. Okay, so now we've talked about number 8 and number 12. And hopefully by now, Mr. Boardwash has his, you're good?
We do one.
1, heck yeah. Well, this is good. I'm glad someone's asking. I'm moving into another question. Learn and Earn is financed entirely by common stock that is priced to offer a 30% expected return. If the company repurchases 50% of the stock and substitutes an equal value of debt yielding 6%, what is the expected return on its common stock after refinancing? Ignore taxes. Okay, the first question is this. It's entirely common stock, and right now it's a 30% expected return. So that is the required return on the unlevered equity. It's also, because it's 100% stock, it's also the required return on the business, right? So required return on those assets. And so that's going to become our R0, which is going to be equal to our R WACC, and it is 30%. If the company repurchases 50% of the stock and substitutes an equal amount of debt yielding 6%, what's the expected return? Okay, well, let's get our old WACC formula up here. And we're going to have the weight on the equity times the required return on the equity plus the weight on the debt times the required return on debt times 1 minus t. But what did they tell us about t? Yeah, ignore it. So we're just going to forget that. Okay, now we can go ahead and start filling in what we know. We know that this RWAC is 30%. We know that the weight on equity is how much?
50%.
Yeah, 50%. Crappy looking 5. And we're going to multiply that by the required return on equity, but we don't know that. That's what we're trying to find. Plus the weight on the debt, what does it have to be?
50.
Yeah, 0.5. Multiplied by the required return on debt, which they tell us is 6%. And so that comes out to be 3%. When I do subtraction, I get 27% is equal to 0.5 times this required return on equity that we're trying to find. What is 27% divided by 0.5? 54%. That may sound high, but it's not unheard of for risky firms. Questions? There was one, okay, so any other questions you guys want to see?
I calculated it differently, but I got the same answer. Would you say it's also fine, since there are no taxes, to, if it's 100% equity, and they reduce it down to 50%, that would double it to 60%, and then just subtract the 6%, also getting you a 54.54.
So let's try that one more time.
If there are no taxes,
Okay.
I just guessed on how to do it, and I still got the same answer.
Hey, you know what? In this world, if you can guess, then you're good to go, right? Now the question is, can you replicate that on an exam?
No.
Then learn the correct way. So I used to work for this guy who flew A-7 Corsairs in Vietnam, dropping bombs on Ho Chi Minh Trail and all that kind of stuff. And first day on the job, he got me and my other little colleague there, and he said, boys, would you rather be lucky or good? And we're like, we'd rather be good. He says, hell no. He says, I know a lot of good pilots that are dead. I'd rather be lucky. Now, take from that what you will, but I think you should learn how to do the problem. Okay. There's probably, so anybody else have another question? Yeah.
Can we do 7?
Yep. Assume the following data for UNP company. Calculate the weighted after-tax cost of capital, 7. Okay, so, it's almost like I need one of those car buffers to do this. Okay. Debt. That's a D. Debt is equal to 100. Equity is equal to 300. What's V? 400. Just add those together because there's no preferred. And so that means the weight on debt must be 0.25. Do you see how I got 0.25? And then what does that mean the weight on equity has to be? Yeah. So now typically my favorite thing to do is to figure both weights and then add them together to check my work. Because the way I just did it, you can't go back and check your work because you're using the check to actually calculate it. Okay, so it's just asking for the RWAC. And it's going to be the weight on the equity times the required return on the equity plus the weight on the debt times the required return on the debt times 1 minus T. And so we have the weight on the equity is 0.75 times the required return on the equity, which they tell us is 14%, plus 0.25 times 5%, thank you, multiplied by 1 minus T. What's T?
35%.
Yeah, it's 35% or 0.35, so this is going to be 0.65. Do you guys see how I took 1 minus 0.35 to get 0.65? Okay, so now we can plug this into our calculator. And I'm just, so the way that I do these is I hit, oh come on, zoom in. I hit clear it, and then I'm going to say 0.75 times 14 equals, and I'm going to store that in location 1. And anytime I do one of these things and store them, what I'm going to do is I'm going to draw the number in a little circle there to remind me of where I stored that number. Then I'm going to do the other side. 0.25 times 5 equals times 0.65 equals, and I'm going to say store 2. I'm going to write a little 2 here to remind me where that's at. Now, when you're just doing 2 terms, it's not a big deal, but when you get into doing stuff like the variance or the standard deviation of a portfolio, you got a bunch of terms. It makes more sense to do this. Okay, so how am I going to get from what I've got here in the calculator, how am I going to get to the answer?
Recall.
Yeah, recall 1 plus recall 2 equals, I'm getting 11.3125%. And when we round that down, it's just 11.31. Other questions? Okay, there's definitely one I want to show you you guys haven't asked about. Number 13. Elk Electronics has bonds outstanding with a value of $3,058,000. It also has 180,000 shares of stock that are selling for $45 per share. The all equity value of the firm is $11.4 million. The tax rate is 28%. By what amount has the value of the firm been decreased by the expected bankruptcy costs? Assume there are no other claims on the firm. This is a little tricky. Okay, first thing I'm going to do is we're going to figure out what would be the value of the levered firm in a world without bankruptcy costs. And that's given to us by this formula here. The value of the levered firm is equal to the value of the unlevered firm plus, does anyone know what's next?
The tax rate times.
Yeah. It's that tax shield of the debt, which is just the tax rate times the amount of debt outstanding. They tell us that the all equity value of the firm is $11,400. Is that right, 11,400? Oh, 11.4 million. Plus, that tax rate is 28%. And how much do they have outstanding in bonds? 3,058,000, does that look right?
Yes.
Okay, so if we do this math, we can figure out what is the value of the levered firm without bankruptcy costs. 11,400,000. Oh, one too many O's. Plus, I'm going to do open parentheses, 0.28 times 3,058,000, close parentheses, equal. I'm getting 12,256,240. Is that what you guys get? Okay, now that would be in our ideal happy fun world where there are no costs of financial distress. However, we have another way of knowing what the market is truly valuing this firm at. How do we figure out the current market value of this firm?
The shares outstanding times the stock price.
Yep. So we're going to take the shares outstanding, which is 180,000. Multiplied by $45 a share. Multiplied by 45. That gives us, does that look right? Yeah, that gives us 8.1 million. So that's the market value of the equity. Is 8,100,000. Now, what's the full market value of the firm? It's going to be this number. It's going to be the market value of the equity plus the market value of the debt. We just said the market value of the equity is 8.1 million. What's the market value of the debt?
3,058,000.
Yep. We add that together, I think we get $11,158,000. Is that right?
Yes.
Okay. Now, in order to find out, so this is what the market is saying the firm is worth. And this is our idealized world with taxes, but without the cost of financial distress. So the difference between these two numbers would represent that cost of financial distress. And so all we've got to do, plus 3,058,000 equals negative plus 12,256,240. And I get $1.098 million, which is that third choice. Is there information there that we didn't have to use? I think we used every single piece of information there. Okay, so that was 13. Anything else you found tricky? Number 22. You own 300 shares of Hanover Company. Stock closed at a price of $35.87 per share today. Tomorrow morning, there's a stock dividend of 7%. What will be the change in value of your investment tomorrow, assuming there are no other factors affecting the market price of the stock? What's the correct answer? 0. Remember we said stock dividends don't make one bit of difference to the value of the shareholder equity. So the amount of your investment or your value there, it stays the same. Did we have to use any of the numbers to figure that out? No, that's really more of a conceptual question. Anything else before we jump back to the slides? Yes?
Is that one on the exam? It was worth a shot.
That's a good question.
You know, hey, it could be. It very well could be. I would, and it's such a simple thing to remember, right? Stock dividends don't do diddly squat. And we're going to see that stock splits don't do diddly squat to the value of your equity investment. You'll see these websites dedicated to predicting who's going to do a stock split next. And people are always wanting to buy on stock splits. And, in theory, there should be no reason for that to create any value at all. Okay, last time we ended up and talked a little bit about dividend signaling. We said that when they increase the dividend, that's a good signal. And what signal does the market read into that?
The firm expects that they're going to be able to sustain increased cash flows, and so they're confident with raising that dividend.
Yeah. So basically the news is, hey, these managers expect cash flows to persist at this new higher level. And so that's the information. And when that information hits the market, that increases the share price. Not the dividend itself, but the information contained in that. Let's see. So it's a sign they're expected to do well. And so it is interesting because, of course, when does this increase in share price actually happen? Does it happen when the dividend's announced or when the dividend is paid?
It's going to be when it's announced.
Yeah, it's going to be when it's announced because that's when the good news comes out, right? Are you going to wait to act on good news? Of course not. Okay, so that's dividend signaling. Now let's talk about the clientele effect. So one of the arguments that people make for why dividends still persist in spite of their disadvantages, and that is that there is a certain clientele of investors who desire dividends. And so we will see that people can be divided into these different groups, and their situations and their tax rates impact whether or not they want to receive dividends. So for instance, high tax bracket individuals prefer 0 to low payout. Right now, tax rates on dividends are 0% for people with an adjusted gross income of this much, 15% for people of this much, and then 20% for everybody above that. Out of those three groups, who would most prefer to receive dividends?
The people with the 0%.
Yeah, the people with 0% taxes. Who would least prefer to receive dividends? Yeah, the people who are paying the full 20. So let's think about how this impacts your life. When are you most likely to be making more money? As an employee, during your career, or when you're retired? Yeah, during your career. So what does that mean about your tax rate during your career versus retirement based on our progressive tax rate system? Yeah, it's going to be higher while you're working. And so do you want to be receiving these dividends while you're working? No. You'd much rather receive them when you are retired. So, example, I hate dividends. I freaking hate them. I would much rather have nothing but capital gain because I don't have to worry about paying any taxes on it. And I'm not going to be touching that money for at least another 12 years. Now, my dad, on the other hand, is 84 years old. What do you think he's more focused on, dividends or capital gains? Dividends. In fact, he gets angry when he is forced to take a capital gain due to a merger. Let's think this through. He has all these stocks that he's put together to create this nice stream of dividends that he quite enjoys. What happens when someone comes along and buys one of those firms out? I'm like, Dad, why are you pissed? They have to pay you a merger premium. They have to pay you more than the shares are actually worth. You should be thrilled. He says, no, because then I have to pay taxes. I'm like, you should be thrilled to have to pay taxes. It means you've made some money. But here's what I was missing out on. There is this thing called the death option on capital gains. My dad was hoping to sit on that stock until he died. And then when it passes from him to his heirs, hopefully I'm one of them, what happens to the tax basis for that? It resets to the price on the day of his death. And so he was hoping to avoid those taxes altogether. So he hates capital gains taxes. He would prefer to get his money in dividends at this point. And by the way, he's a retiree. He's not raking in all sorts of dough from a job. And so his marginal tax rate is lower. So it makes perfect sense that he wants dividends and that I do not. What about tax-free institutions? Let's talk about what kind of institutions are tax-free. Pension funds, university endowments, these sorts of things, charitable endowments, charitable foundations. In those situations, if they are not paying any taxes, is it really going to matter to them which one they receive? They're not going to pay taxes on either one. And so the question is, you have to ask, what is the purpose of those institutions? And they both do something where they spit off cash to either fund pension benefits or activities at the university. For instance, I am an endowed chair. What does that mean? It means that someone sometime or the other, endowed professor, sorry, I used the wrong term there. Someone somewhere put in some money into our foundation, and that every year that spits off a certain amount of money that they use to kind of juice my salary, which is really nice. I appreciate that. Now, how does that work? Well, you've got to have money coming in to pay off those promised cash flows out, but you would also like your principal to grow at the same time. And so that's why we're saying that tax-free institutions would prefer a median payout. They need some cash to take care of obligations that are going on right now. They need to have that capital grow so they can take care of future obligations. And then finally, we have corporations. And when we first started talking about clienteles, back then, corporations had a 70% dividend exclusion. What's a dividend exclusion? It means that if they received $100 in dividends, they only had to pay taxes on $30 of that. And you might say that's terribly unfair. Why are corporations allowed to skip paying taxes on 70% of their dividends? And it all boils down to the way cash flows are taxed. So if you think about a corporation, when a corporation makes money, they have to pay a sort of income tax. What's it called? Yeah, corporate taxes, right? I'm not trying to screw you up here. Corporate income taxes. And so then, let's assume that the corporate taxes are 20%. And you've got $1 worth of cash coming in, or earnings at the company, or pre-tax earnings. So the company has to pay 20 cents in taxes. So how much is left to pass of that dollar on to the shareholders in dividends? 80 cents. But when it comes to the shareholder, assume it's me in my situation, my dividend tax rate is probably 20%. And so I end up having to pay another 20%. 20% of 80 is 16 cents. Now we're down to 64 cents. What is the effective tax rate? We've gone from $1 down to 64 cents. It sure looks to me like a 36% tax rate. And when you hear these people complaining about rich people not paying their fair share of taxes, what they're missing out on is that the cash flows that those rich people get in dividends have already been taxed once, and now they're paying the tax again. And so maybe 20% is lower than the marginal tax rate that I'm paying for my income, but my income is only getting taxed once. Those cash flows to the corporation are getting taxed twice. Now, if we're a corporation that owns shares in another corporation and there wasn't this exemption, what would happen? Well, now we've got this 64 cents that we're going to pass on to our shareholders as a dividend, and it's going to get stepped on one more time. Now, I can't do this math in my head, but if you take another 20%, actually I probably can. 20% of 64 is what? 64 divided by 5, 12 point something. 12.8. Okay, so now we're going to say 64 minus 12.8, and that shows us how much money. I mean, we're almost at 50% taxation at that point. Folks, that's European levels. We're not going to live like that. And so that's why we don't do that. Now, I do have some bad news. After the last tax law change, the exemptions switched from being 70% down to being 50%. And so now corporations are paying more in dividend taxes, except for in one situation. If you can own at least 80% of the shares in the company that you're investing in, then the dividends are tax-free. And here's why. That is considered to be an unconsolidated subsidiary. In other words, if I own 80% of something, basically I own the damn thing, and any money being transferred from it to me is not so much a dividend as an intra-firm transfer. Inter-firm would be between firms. Intra-firm means within the same firm. We do not tax intra-firm cash flows, so therefore the dividends that are paid by this unconsolidated subsidiary will not be taxed. This is why when you see people doing acquisitions, when they're trying to acquire, they may only need 67% of the votes to complete the acquisition, but they will actually want to go after 80% of the stock to avoid paying this dividend tax before everything gets squared away. Questions? Okay, now, let's assume that right now people want dividends, more people want dividends than are able to get them. If I am a non-dividend paying firm, I can announce I'm going to start paying a dividend. And now that puts me on the radar of the people who want dividends. And those people are going to bid up my share price. So as a result, I have actually maximized shareholder wealth as a result of paying dividends. Let's go the other way. What if people would prefer firms that don't pay dividends? Then, and it's going to be bad to cut a dividend, but if you make the announcement, we're going to focus on producing capital gain, then maybe the value of the firm gets bid up by those who prefer capital gains. So what we're saying here is people will bid up the price of whatever they want, but only until that group of people is satisfied. Once we have enough firms offering enough dividends, there's no additional value to be gained from suddenly start to pay dividends. Do you think that the market right now is at an equilibrium where companies have already moved enough that there's no value left in paying dividends? I think in an efficient market, smart managers are going to figure this out, and they'll keep jumping over until it stops giving benefit, and then they'll stop. And so if we are in an efficient market, we should assume that we are currently in equilibrium. In other words, if your firm is not paying a dividend and your sole reason for beginning to pay a dividend is because you want to appeal to the clientele, don't do it. They're probably already satisfied. Questions? By the way, do you think the size of these different clienteles could change over time? Yeah. So right now, the baby boomers, do you guys know who those people are? They're mostly retired at this point. Biggest freaking generation in American history. Earlier, 30 years ago, do you think they were a pro-dividend clientele or a pro-capital gains clientele? Yeah, capital gains, because they're working, right? They don't want to pay those taxes. But now that they're retired, they're probably a pro-dividend clientele. So there was probably a time when it would pay to switch from being a non-dividend payer to being a dividend payer. But as those boomers, let's say age out instead of die off, as they age out of collecting money, maybe that clientele will start to shrink, and maybe the incentive will not be there. And then we'll see maybe go back the other way. I don't think we'll see firms stop paying dividends, but what I think is we'll see new firms coming in being less likely to pay dividends. Okay, questions? So what do we know and what do we not know? First of all, we know that dividends are large in the aggregate. If you look at the amount of dividends paid in dollars, it looks like this over time. However, if you look at the number of companies paying dividends, it looks like this. It's going down over time. How can those both be true? The companies that pay are paying more, and the ones who are not paying are the smaller companies that typically did not pay dividends anyway. If you roll back 20, 30, 40 years, when a company first went public, it was entirely likely that they would actually pay a dividend. And the trick is, the reason that happened because the companies that were doing IPOs back then were mature companies that already were profitable. But then over time, what have companies started to look like at IPO? Are they mature? Mr. Buat, what do they look like now?
Half of them don't even have revenue.
Oh yeah, half of them don't even have revenue. So there used to be, well, we don't want to go public until we have a profit. And then it was, well, we shouldn't go public until we have at least some revenue. And now it's like, hey, we've got an idea. Would you guys like to buy our stock? So that's kind of what's happened there. All these new entrants coming in are less likely to pay because they are new companies, young, unprofitable. So they're not the kind of companies that pay dividends. By the way, let's talk about the probability that a company is going to pay dividends based on its age. Who's more likely to pay dividends, a young firm or an old firm? Old. So you think about there's a life cycle at a company just like there's a life cycle with people. When we are babies, between age 0 and age 1, our weight roughly, and I'm not into babies really, but I think the weight roughly doubles. Does that sound about right? No? You don't know? I never made one. Don't know. Okay. But I do know they grow really fast that first year. Do they grow at that same rate the second year? No. If we kept growing at that same rate, by now I would weigh like 40,000 pounds, right? It doesn't work that way. So it looks kind of like this. Now, companies are kind of the same way. They grow fast in the beginning, and as they're growing, what are they going to do with their earnings? Are they going to pay them out as dividends, or are they going to reinvest them in the firm?
Reinvest.
Yeah, they're going to reinvest them. And so basically, we have to wait until the firm gets to a point in its life cycle that it actually has more money coming in than it needs to fund all of their positive NPV projects. And at that point, we should start to see them paying dividends. Now, the neat thing about a firm versus a human is that a firm does not necessarily have to die. And so they could reach this level of maturity and then hit what we call the cash cow stage, where they just keep paying the dividends. They're not growing any, but they just keep paying nice dividends. And so this is why we see these older companies paying, more likely to pay dividends, and when they do pay dividends, it's a bigger proportion of their net income because they are just later on, they're more mature. Questions? What's a better investment, a new company or an old company? They're all fairly priced, right? The market is out there pricing the probability that this new company is going to die, pricing the probability of growth at the old company. And that's the really neat thing about having efficient markets with lots of players. We don't have to worry about, do I want a high PE firm or a low PE firm? You don't care, right? Because they're all fairly priced. Does it mean they're all going to go up? No, because everything's an expected return, right? If we knew the future with certainty, we'd be perfectly fine, right? But we're just looking at expected returns. Okay, now, what we've talked a whole lot about here, and we've mentioned about how taxes and how high tax people want this and low tax people want this. But what does the evidence actually say? When I was a boy, back in the dark ages, dividends were taxed as regular income. And those tax brackets, in my memory, went up to like 39.6%. Right after World War II, they were up to like 94%. And so you'd think that would be a real disincentive to pay dividends. But then in 2002, 2003, about the time you guys were being born, we got a new tax regime that basically taxed dividends and capital gains the same and at a lower rate. As a result, you would think that that would lead to an explosion in dividend paying because there is less of a tax burden now than there used to be. Do you think we witnessed an explosion in dividend paying? No. And so what we see is our theory says that taxes shouldn't matter, but in reality we don't see it impacting the way that we would theorize it to impact it. I've already talked about fewer companies paying dividends. We also know that corporations smooth dividends. They smooth dividends because we know there is an asymmetric impact to announcing a dividend cut versus an increase. If I announce a $1 dividend increase, my share price might go up 10%. If I announce a $1 cut, my share price will go down far more than 10%. And so we don't want to start paying a dividend that we cannot maintain, and so managers are cautious about raising them. And so they will try to come up with a smooth growth rate for those dividends. Let's consider the alternative. What if instead we had a payout policy where we had a payout ratio that we always stuck to? Payout ratio is dividends divided by net income. Let's say that I always pay out half my net income in dividends. What would that lead to? Do you think net income is going to grow smoothly like that? No, it would lead to my dividends jumping up and down, and it would lead to potential issues with shareholders reading things into this that they shouldn't. And so as a result, what we see is dividend smoothing. So we say that we know that dividends provide information to the market. We've already talked about that. Let's talk about firms should follow a sensible dividend policy. One of the things we mentioned is you should not forego a positive NPV project just to pay a dividend, because we know that positive NPV projects increase shareholder wealth. Giving that same money to the shareholders is not as value enhancing to them. We should avoid issuing stock to pay dividends for at least 2 reasons. Number 1, we know we're going to have to pay an underwriter to do so, which is going to cut into the amount of money we actually have to turn around and pay to our shareholders. And they're going to have to turn around and pay taxes on that. So there's 2 reasons. And the third reason would be it sends a bad signal to the market when you sell more shares. And so there are all sorts of good reasons not to issue stock to pay a dividend. If you find yourself in a situation where times are bad, but you want to signal to your shareholders that the troubles are just temporary and you have a solid plan for getting out of it, you might go out and borrow money to pay a dividend. And that would actually be a positive signal. Remember we said when people borrow money, it's a sign that they think that they're going to have the cash flows necessary to meet those fixed debt obligations. So it's a double signal. I'm going to keep my dividend as it is, and I'm going to go out and borrow money. Tells you that I think things are going to be good down the road. Now, can crappy firms pull off that signal? No. Why not?
It's hard for them to get debt.
Okay, so hard for them to get debt. Assume that they could fool some schmuck into loaning them money. What's going to happen 6 months from now when they've got to make the coupon payment? Yeah, they're not going to be able to. Okay, and we should consider share repurchases when there are not better uses for the cash. So here's what I would tell you is that we've got basically two kinds of cash flows coming into the firm. We've got what we would call the firm's permanent cash flows, and then we have these like windfalls that come in. So for instance, think about Google. Google has this business called AdWords. You guys may not realize it, but that is the core of Google's business. Every time you put in a search on Google and it basically sells you. And the words that you put in, people have bid on them previously to, well, I want to be first on the list. If someone puts in electronic bullhorn, if someone puts that in, I want to be top on the list. And people bid on this. The second highest bidder gets second on the list. That's billions and billions of dollars every year, and it comes in like clockwork. So that's like a permanent set of cash flows for Google. But what about when Google does something like selling off its self-driving car division? You got a one-time cash flow coming in. That's not going to be repeating. So how should this impact your dividends? Only base dividends on that permanent set of cash flows. Do not base dividends on these things that fly in from outer space. When those things fly in, hey, I'm glad to take an extra $3 billion here, but I'm not going to boost my dividend as a result. Instead, I'm going to do a share repurchase. Share repurchases aren't a promise to keep paying like a dividend is, and so I would rather do that with temporary excess cash. Questions? Okay, so we just discussed aggregate dividends are massive and increased over time. Although the number of dividend payers has gotten smaller, that dividend payment is really massively concentrated among a few large companies. By the way, did you know that the S&P 500 right now, I think 40% of the value comes from the top 7 firms? Okay, so does that tell you the S&P 500 might not be as diversified as 500 would make you think? Because it's a market-weighted portfolio, right? Dividends, let's see, managers are reluctant to cut dividends. We know the reason why, because they're going to get beat up in the market when they do that. Managers smooth dividends. They want to avoid sending spurious signals. And we know that stock prices react to unanticipated changes in dividends. The important word there is unanticipated. If the change in dividend was expected, what would have happened to that information? It would already be in the share price. So it's only unanticipated increases or decreases in dividends that impact the stock price. And we also know that the size of stock repurchases tends to go right along with those transitory earnings. Those are the ones I was telling you that fly in out of space. They come and they go. You can't count on them. Those kinds of cash flows, we would use share repurchases to return that money to the investors. Any questions? So what does a sensible payout policy look like? First of all, we're going to pay out all free cash flows over time. 2 key words there, free cash flows. What are free cash flows?
Cash flow flows that aren't going to be used for other projects.
Okay, so it's all the cash that's coming in that's not needed, or after we pay all of our bills and our liabilities, that cash that is over and above that which is needed to invest in all of our positive NPV projects, that stuff's considered free cash flow. And we want to pay that out over time. Do I have to pay it out immediately? No. If I think, for instance, we're getting ready to go into a government shutdown and I might want to have some extra cash on hand, I am not forced to pay that out immediately, but over time, I should definitely be paying out all that free cash flow. We should avoid passing up on positive NPV projects. We've already talked about that. We want to wait to initiate dividends until free cash flow is substantial. Why? Because we want to make sure that free cash flow is in a sustainable, permanent amount, because we don't want to have to cut those dividends. Set the current regular dividend consistent with a long-run target payout ratio. Now notice here that it's a long-run target payout ratio. We're not trying to pay out exactly 50% of our net income in each quarter. Over the long run, we're trying to pay out 25% of our net income through dividends. So don't change it every quarter. Set the dividend low enough to avoid expensive external financing in the future. This is one of the reasons why people are reluctant to raise dividends, because if they raise dividends and pay out some cash and then they might have to go outside and get some additional funding, then they find themselves in a world of hurt, because issuing additional shares sends a negative signal. Let's talk about Huawei. Do you guys know who Huawei is? No idea. Yeah, they make phones, and where are they based out of? China. And Huawei was going great guns until 2019, when the United States figured out that the Chinese People's Liberation Army was putting spyware and stuff in their routers and phones. And so we said, no, we're not interested in that anymore. They were actually our biggest supplier at the time. Now, they took a hit, but they've been growing 22, 23, they were growing. But now, just lately, they announced that they are they're selling debt. And we said that selling debt is a good sign, except for one thing. They said, and by the way, when you sell debt, one of the things that you have to say is, what are you going to do with the money? And so there are a couple of good answers. Number one, we're building a new facility in Malaysia. That would be a good one. Number two is kind of sneaky, but you say general corporate purposes. Is that really saying anything? Other than saying that you're not borrowing to buy a specific asset, it doesn't say anything. But what Huawei said made the hairs on my neck stand up. And that is that they needed funds for their operating capital. What does that mean about their net working capital before they made the issue of the debt? It was negative, right? It was negative. What kind of a company gets in a situation with a negative net working capital? One that is in trouble. Now let's assume that Huawei had been paying out dividends along the way. Now they are in a situation where they wish they had not paid out the dividends. So that's another reason not to pay out dividends. And we've already talked about using repurchases. I really need to go back and tease out these slides because they got a lot of repetition in them. Let's talk about stock dividends. We talked a little bit about these earlier, and we said that they don't increase the value. It just increases the outstanding number of shares, but reduces the price. At the end, after this is over, as we said in question number 22, what change does it make in the value of your stake? Nothing, right? No change at all. And we have these things called small stock dividends and large stock dividends. And as far as I can tell, the only difference is in the accounting treatment. In a small stock dividend, the value of the stock is taken out of addition to retained earnings. In a large stock dividend, it's taken out of the additional paid in surplus or whatever it's called. But long story short, Do I expect to test you on that little piece of weird knowledge? No. Here's what I do want you to know. Remember, on the balance sheet, we basically have two accounts that are for the stock that we've issued. The first one is called common stock, or common stock at par. And the other one's called capital surplus, or additional paid-in capital. The amount in that common stock at par account is the number of shares issued times the par value. So that first account you see is just the number of shares issued times the par value. Why is that important? Because if you are given a problem and you're trying to figure out how many shares a company has, all you have to do is take that common stock account and divide by the par value, which will be stated, and it'll tell you the number of shares outstanding. And that's actually one of the problems on our exam practice there, included doing that. Now, when people buy shares, let's assume that the par value is $1 per share. When we sell a share for $10 in the IPO, $1 would go to the common stock account. The other 9, 10 minus 1, would go into that additional paid-in capital or capital surplus account. Questions?
Can you run back over what you were saying about the calculation of common stock at par?
Okay, so the common stock at par account is basically just the number of shares that the firm has ever issued. So it doesn't matter whether it was IPO or SEO. Do you know about SEO? Seasoned equity offering. It comes later. It's basically the same idea, only if the stock's issuing more shares now. It's an additional equity issuance. However many shares the company has ever issued, multiplied by that par value per share, which is usually like 60 cents or $1 or something like that. That's going to give you the common stock account, which usually says at par 60 cents per share, or something like that, off in parentheses next to it. Now, are we really selling shares for 60 cents a piece? No, we're selling them for more than that. Let's say we're selling them for $5. So for every share that we sold at $5, we would add an additional 60 cents to that common stock at par of 60 cents account. And how much would go then to our additional paid-in surplus? $5 minus 60 cents would be $4.40. Does that straighten it out for you? Very good, thank you. I hate the fact it says less than 20 to 25%, more than 20 to 25%. What does that do for us? It leaves us with this freaking no man's land between 20 and 25% where we don't know whether to classify it as a large or a small. As an engineer, that just drives me nuts, right? And you would think accountants who came up with this crap would be driven nuts by it too, but apparently not. So here's our stock dividends example. You own 100 shares worth $50 each. The company declares a 10% stock dividend. Your total wealth beforehand is $5,000. You're going to get an additional 10 shares, so now you're up to 110 shares. However, each one of those shares, price will fall as follows. We're going to take the share price beforehand and divide by 1 plus the stock dividend percentage. And so here we're dividing by 1.10, and that tells us that the stock now is worth $45.45 a piece. Multiply by your 110, this new glorious 110 bigger amount of shares that you've got, and lo and behold, you've got exactly the same amount that you had before. So the bottom line is stock dividends don't affect shareholder wealth. I don't know why anyone does them unless there's actually a group of people out there who are not clever enough to realize that it doesn't do anything. Stock splits are a little different story. A stock split, usually what we see is a company like Walmart or Amazon, when their stock price gets pretty high, then they split. And the whole idea is to put those shares back in what's called an ideal trading range for the shares. Remember that the bid-ask spread on stock, the lowest it can be is 1 cent, and it's going to be a few cents at most. And that is how a dealer makes their money handling the stock. And so in order to make dealers interested in handling our stock, they would prefer to have a lower price per share because that makes their percentage higher. The bid-ask spread remains roughly the same, but the share price is lower, so the percentage that they're getting out of that sale is higher. And so it makes sense if we've got a share that's like way up there, if we split it, 10 for 1 or whatever, and get it back into a more reasonable trading range, more dealers will be able to handle our shares, be willing to handle our shares, and the market in our shares will be more liquid, and therefore they'll be worth more overall. What about people's ability to afford shares? Back in the old days, we were not allowed to buy anything less than 1 share. And if you didn't order a round lot of 100 shares, then your commission per share was extraordinarily high. What can you do now? Mr. Bardwash, can you buy fractional shares with your Robinhood account? Yes, he can. And, it doesn't matter what Berkshire Hathaway is trading at. He can still afford to buy 0.0001 shares, right? Kind of like with Bitcoin now. How many Bitcoin can you afford? 0.00000, right? Yeah. By the way, I have a friend who mined a bunch of Bitcoin, and this is December of 2017, and they were trading at around $17,000 a piece then. And he told us that he had this whole block of Bitcoin that he mined back early in the day. And I said, dude, sell that shit. It's a total bubble. What's Bitcoin selling for today?
Over 100.
Yeah. I'm so glad he didn't take my advice. Now, am I saying you should buy Bitcoin? No. Will I ever buy Bitcoin? I doubt it. Okay, so a 2-for-1 stock split is actually the same as a 100% dividend as far as the number of shares that you end up with. Now, what happens on the, we said that some weird stuff happens with the addition to retained earnings and addition to additional paid-in capital when we do large versus small. On a stock split, those accounts don't change one bit. The only thing that changes is the par value. If I do a 5-for-1 stock split and the par value was 60 cents, now it's 12 cents. Stock splits, basically, same idea. It increases the number of shares outstanding but reduces the price. Should not create any value whatsoever except for moving these shares into that more favorable trading range. So you own 100 shares worth $50 each. The company declares a 2-for-1. You can walk through the math there. The total wealth is the same before and after. Now let's talk about the other direction of this, and that's the reverse stock split. You've got 10 shares and they're going to trade that for 1. Why would a company do that?
Keep their share price above a certain level.
Exactly. So let's say your stock was at $10 a share, you're doing just fine, and then hard times fall in your company and your stock goes down, 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 and now you're down to about 78 cents. You just got a call from NASDAQ. They said, hey, by the way, your shares have to have a value of at least $1 a share in order to be traded on NASDAQ. You've got 30 days to get your crap together. Well, I can do one of two things. Either I can do some amazing things that raise the share price, or I can do a reverse stock split. I'll do 10-for-1 and get my shares up to $7.80 a piece. Have I created any value? The only thing I've done is avoid destroying value, because when the shares get delisted, the stock is no longer liquid and it makes it worth far less. So I didn't create any value, but I avoided destroying some value. Any questions?